Well, I have never made a video quite like this one. Today I am going to show you a specific financial situation that I have found myself in, and I am actually going to ask for your perspective because I do not have a perfect answer for this problem, and I thought it would be interesting to bring it directly to my audience. ChatGPT gave me a couple of answers when I plugged it in, but I did not love any single one of those options. And I am genuinely wondering if any of you out there have anything truly innovative to solve this particular structural issue. It is not a massive catastrophe by any means, but it is a psychological friction point that forces me to think deeply about efficiency. So let us set up the background structure of how we got here. I officially retired at the very beginning of the year 2019, and at that specific point in time, the fixed income market and the bond market were paying, and I am being extremely kind here, significantly less than 1%. It was a painful, miserable time period to hold cash or debt assets because they were basically paying nothing. They were absolutely failing to keep up with the rate of inflation, and I simply did not want to have any significant portion of my money tied up in that garbage. I also happen to have, and I think this is an important psychological note to understand, a massive structural bias for equities and individual stocks. I was 100% invested in stocks and equity funds throughout my entire working career when normal regular income was actively coming in. So I always had that steady stream of capital supporting my aggressive stance. Complexity is a status signal for people who want to feel smart but stay poor, while the simple reality is that the mathematical trap of overcomplicating things is usually what breaks an investor. If you cannot explain your portfolio plumbing to a 12-year-old child, you are not actually investing. You are just gambling with your life savings and hoping the market does not expose your lack of discipline. My original framework relied on what I call bucket one, which is strictly short-term money that I want to be completely safe, and it represents the capital that I actively spend out of to fund my daily life. Back in 2019, I structured this to hold exactly 3 years of living expenses, and to be precise, this number is entirely net of any other passive or structural income I have coming in. So for example, if I needed $50,000 a year to live and I had $20,000 coming in from deferred compensation, I only needed to pull $30,000 a year from my actual portfolio. Therefore, the calculation was simple. I needed $30,000 multiplied by 3 years, which equals $90,000 sitting directly in this safe bucket one. Now, those are not my exact real numbers, but you understand the mathematical logic behind the setup, and right now, I keep that specific layer of capital parked in a Fidelity money market fund. But during my first few years of retirement, I found myself chasing a lot of different returns, putting in a massive amount of cognitive effort for very little actual bottom line impact. I was buying individual certificates of deposit, I was tracking down Series I savings bonds, I was holding a messy mix of different individual bonds, and looking back, it was just an unnecessary administrative mess. But for the sake of understanding this setup, just think of bucket one as 3 years of pure fixed safety. Then I created what we will call bucket two, which was designed to hold the money I might eventually need to draw from during years 4, 5, and 6 of my retirement journey. That was the timeline where I needed that specific layer of capital to transition into safety according to my original retirement roadmap. Remember, at that specific point in time, I was not making a single dollar of YouTube income, so I was entirely dependent on the structure. This was another 3 years of living expenses. And because interest rates were so pathetic, I decided to place this money into balanced funds, specifically something like the Wellington Fund, which operates as a classic 60/40ths balanced asset allocation. I split it right down the middle, keeping half of it in that traditional balanced fund and the other half in a dedicated dividend-paying equity fund. I generally hate to recommend specific funds to people, and that is the exact reason why I do not recommend individual tickers at all on this channel, which is why I prefer to talk about these categories generically. Back then, I looked at the landscape and said to myself, I absolutely cannot stand getting less than 1%, sometimes 0.5% or 0.4%. So I am going to lean into the risk curve just a little bit with this midterm capital. I felt pretty comfortable with bucket one and bucket two acting as my pseudo-fixed income allocation, even though bucket two was obviously not truly fixed, but rather leaning slightly towards fixed characteristics to capture a higher yield. I apologize for the crude nature of my visual chart on the whiteboard here, but my final layer, which is bucket three, was always kept 100% in pure equities for long-term growth. That was the original setup from 2019, and hopefully that layout makes complete sense to everyone watching. Now, let us fast forward the tape to May 2026 to look at the current state of affairs. Because the landscape has shifted dramatically in bucket one, instead of holding just 3 years of expenses, I now find myself holding a massive 10 years of living expenses completely secured and insulated from equity market volatility. Again, this is net of my current income streams because I still have deferred compensation coming in for another 4 years. I have a small structural pension and I now have a steady stream of YouTube income. But the reality is that I currently hold 10 years of expenses in this safety zone. And this did not happen by accident. It was entirely by design, which is a topic for a completely separate video. I deliberately picked a 10-year cash runway, and roughly 50% of that capital is currently sitting in a money market fund with Fidelity. Specifically, the SPACs ticker, I guess I previously said I was not going to advertise specific funds, but it is relevant here because because I just looked at its trailing 3-year return and it is sitting at 4.63%. That performance is obviously a hell of a lot higher than 1%. It is significantly better than the rate of inflation, and I really like the simplicity of that specific fund. It gives me incredibly easy access to my cash, meaning I can liquidate and move that money out of Fidelity within 48 business hours under the absolute worst case scenario, though. Most of the time it lands in my hands within 24 hours. So it is an incredibly smooth, frictionless process for me to execute when I need to transfer money over to my checking account. The remaining 50% of my bucket 1 safety money is parked in a broad bond fund inside my traditional IRA. I just checked the performance for the last single year, and it delivered a very solid 5.44%. Now, I have not always been lazily sitting in this specific bond fund. I was smart enough to completely avoid bond funds during the absolute bloodbath of 2022, when regular fixed income investors took a massive 15% haircut on their supposedly safe assets. I timed my entry into this fund at the very beginning of 2024 because, as I mentioned, 2022 was exceptionally ugly for bond duration risk. Looking at the trailing 1-year return of 5.44%, I have been deeply satisfied with how my bucket 1 money is protecting my peace of mind. My approach is incredibly simple. I just use 2 distinct funds for this entire 10-year safety layer. I suppose you could technically count my standard checking account as a third bucket, since that is where I physically spend money from. But I only keep about a single month of expenses in there, constantly refilling it by moving cash over from the core money market fund. Now we get to bucket 2, and this is where the massive structural optimization opportunity lies. Just for the sake of an easy mathematical example, let us say I have roughly $400,000 sitting in this specific bucket, and it happens to have a $200,000 cost basis. That detail is incredibly important to understand for the dilemma I am facing. Half of that capital is in the balance fund, and the other half is in the dividend-paying equity fund. Now, the objectively great thing about this setup is that the compounded annual growth rate since I originally bought these funds sits at 11% and 9% respectively. If I stand back and objectively analyze bucket 2, which started as a random experiment back in 2019 to avoid low interest rates, the strategy worked brilliantly. In fact, it worked entirely too well. I originally created that middle bucket simply because I absolutely hated the returns in bucket 1. I completely despised the microscopic fixed returns available at the time, and this equity lean paid off very handsomely. I have absolutely zero regrets about making that move. But its massive financial success has now created a significant structural problem. Meanwhile, bucket 3 is doing fantastic, sitting at 100% pure equities for the long haul. I hold roughly 90% of that growth capital inside a traditional IRA, and the remaining 10% is tucked away inside a Roth IRA. My long-term goal is to keep increasing the percentage inside the Roth IRA, but the underlying investments just keep going on an absolute tear, and the traditional IRA keeps growing at a pace that is far faster than my ability to manually convert or contribute money into the Roth. So, here is the exact logistical problem, and it centers entirely around bucket 2. I am currently reinvesting all of the dividends inside this taxable environment, meaning I am not using any of the cash flow it generates to fund my lifestyle. Things like my steady YouTube revenue are causing me to completely bypass this money. My original 2019 plan was to take those quarterly dividends and the underlying interest payments and let them naturally flow into bucket 1 as a passive cash replenishment system. But because my YouTube income is completely offsetting my living expenses, I do not actually need that cash flow, which creates an annoying, unnecessary tax drag every single year. I am stuck paying income and capital gains taxes whenever the fund managers happen to rebalance and sell internal positions inside these mutual funds. Plus, I am getting hit on the dividends and interest distributions that I do not even turn into spending money. If I look at my entire financial picture objectively, bucket 2 no longer serves an actual operational purpose in my long-term plan, and that is the core issue. My bucket 1 already provides me with a full 10 years of fixed safety, and my bucket 3 holds all of my long-term equities for massive growth. Those are the only 2 foundational levers that I feel I actually need to maintain a clean, simple, and automated financial life yet. I am left holding this massive residual position in bucket 2, which is a pure holdover from an era when fixed assets paid nothing. It is obviously a fantastic problem to have, and I am certainly not sitting here complaining about making too much money. I am just looking at this from a pure optimization standpoint, asking myself if there is a smarter strategic action I should be taking right now. What are your creative ideas on the specific actions I should take with this money? Keeping in mind that if I simply click the sell button today and reallocate it entirely into clean equities, like the SP 500, I will instantly trigger $200,000 worth of taxable capital gains. And I really do not want to hand that cash over to the government if I can avoid it. So, Let us walk through the realistic options that are currently on the table, and I want to hear your thoughts on these choices. I have listed 4 distinct paths forward, and none of them are incredibly amazing, but none of them are inherently bad either. Option number 1 is to immediately stop reinvesting the dividends and interest inside those bucket 2 funds, and instead redirect that raw cash flow to buy a clean, low-cost index fund, like the SP 500 VO tracker, directly inside my standard brokerage account. That is a very simple passive move that anyone can execute with a few clicks. It slowly begins to mitigate the compounding tax drag over time, but it is certainly not a dramatic transformation, and it moves the needle at an incredibly slow, multi-year pace. Option number 2 is to completely keep the funds exactly where they are, but formally set up a donor advised fund to handle our charitable giving, both for our current life and our long-term legacy. My wife and I already actively give away money today, and we have concrete plans to leave a substantial legacy behind, so using the highly appreciated shares in Bucket 2 to fund a donor. Advised fund would allow us to completely bypass the $200,000 capital gains tax problem altogether. Yes, the underlying assets inside a balanced donor fund might not grow as aggressively as they would if they were parked entirely in a pure equity index like VU. But if you are deeply terrified of taking a massive tax hit on $200,000 of gains, this is a highly functional option that aligns perfectly with our personal values and our long-term family roadmap. Option number 3 is to just pull the trigger, sell the entirety of Bucket 2, pay the required capital gains tax, and if there is any additional net investment income tax that gets triggered by that massive liquidation, just accept it as the cost of doing business. You just do it, you pay the bill, you move on with your life, and you leave the structural problem completely behind you. This specific path could be executed through a few different sub-options over various time horizons. For instance, you could liquidate the entire position in a single tax year. You could split the sales across 2 calendar years, or you could systematically unwind it over a full 5-year period to intentionally keep your annual income lower, potentially eliminating the net investment income tax entirely while only paying the baseline capital gains rate. That gradual liquidation strategy might very well be the mathematically correct thing to do to clean up the portfolio architecture. Then we have option number 4, which is to literally do nothing and just be happy with the current state of affairs. The returns on these funds are objectively nice, and when you combine the performance of the balance fund and the dividend fund, I am locking in roughly a 10% compounded annual growth rate since 2019. There is absolutely no reason to feel bad about an investment that is quietly compounding your wealth at 10% a year without requiring any daily maintenance or operational stress. That is actually an exceptional result for a midterm allocation. So those are the 4 basic paths I have mapped out, and I would love to read your comments down below about what you would personally do if you were standing in my shoes. If your choice is one of these 4 options, let me know, but I would be even more excited if someone could present a hidden option number 5. That provides an elegant, outside-the-box solution to this specific capital gains dilemma. I arrived at this position for incredibly good reasons, and I am only facing this issue because my original 2019 strategy was wildly successful beyond my absolute wildest dreams. But now I am left sitting here with a massive embedded capital gains liability and an asset mix that does not cleanly fit into my Bucket 1 safety allocation or my Bucket 3 growth allocation. Now that traditional fixed assets are finally paying a decent yield, the landscape has changed. Some of you macro watchers might be thinking that if the Federal Reserve decides to aggressively lower interest rates again in the near future, I might suddenly find myself wanting these exact investments back as a protective buffer. Since a 60 divided by 40 dividend, focused allocation sits right in the sweet spot of what people look for when cash yields disappear. If that is your viewpoint, it falls squarely under option number 4, which is to just smile, accept the inefficiency, and enjoy the returns. Let me know your precise thoughts in the comments below. This is DDO3 signing off for now.